Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Global sell-off. President Trump's announcement of a minimum 10% tariff on all exporters to the U.S. spooks investors. Havens rally on fears of an escalating trade war. Do not retaliate. U.S. Treasury Secretary Scott Bessent warns trading partners it could get worse if they fight back. And oil declines on fears a trade war could threaten global demand, despite energy being spared in the tariff rollout. Well, it has just gone 8 a.m. across the Emirates. I'm Jumana Bersechi in Dubai. Good morning, everybody. And if you are just waking up, let me just tell you, the world has changed. We are in a very different environment today than we were 24 hours ago. The Trump administration has roiled global markets with the tariff announcement. 10% tariff, global tariffs to be applied on every single imported good into the U.S. And it's not just that. There are going to be extra reciprocal tariffs applied on around 50 nations, taking the tariff rate on some countries, in the case of China, to above 50%. So these are extremely high tariff rates. In fact, these are levels we have not seen over the course of the last century, just to give you some historical context. So this is the reaction behind me. As you can see, a sea of red for these global markets. S&P futures down 2.7%. We had already been talking about the fact that there was nervousness going into this big D-Day or Liberation Day event. S&P tracking negative for the year, and technically in correction territory, a pullback of 10% from the most recent peak. Take a look at the NASDAQ as well, down 3.2%. Today's trading aside, we were already down about 8% for the year. Again, this tracks us now more than 10% weaker year to date for the tech-heavy basket within the U.S. But it's not just the U.S. Obviously, take a look at European futures, down 1.7% this morning. This, despite the fact, as we've been talking about, the gains for the year are still holding on. The European markets are still up 8% year to date. But again, now lots of uncertainty. This morning, we've heard of the European Commission President Ursula von der Leyen talking about potential retaliation. Things could get worse. There's still a lot of question marks ahead of that actual implementation date, which is April 9. So keep an eye on European markets. And then the handover from Asia, no surprise here, also very negative as well, down 1.4%, with markets from China to Vietnam being absolutely roiled this morning. This is a picture for safe havens, though. As you can see, the yen, a lot of money flowing into the yen, despite the fact that the Nikkei is pulling back. It's 1.3% firmer versus the USD. The theme is dollar weakness this morning. Gold, record highs once again. We're through $3,100. 150 is where we're at, 0.4% higher in the day. 10-year yields, take a look at this. Look how much we've rallied. 7 basis points. We're about to break through 4% again, 4.05. So lots of money pouring into U.S. Treasuries, and this on concerns about the U.S. growth outlook, with Polymarket raising their recession probability odds to over 50%. And then oil, also real concerns here about the fundamentals and global growth demand drivers. Oil just sitting at $70, down 2.4%, about to break through 70. Let's move on and talk about how markets in Asia are faring. Avril is in a Singapore studio. Avril, what a monumental day. Just walk us through the price action with these markets.
Absolutely, Jumana. I mean, I think it cannot be overstated what we're seeing in markets today amid the upending of global trade. So the ones that are getting hit the hardest in terms of equities, Japan and Vietnam. For Vietnam, 46% tariffs. This was certainly not something that markets were positioned for. We're seeing an extension of declines on the benchmark in the country, almost 6% down now. The currency has plunged to the lowest on record. And amid these concerns about global growth, we're seeing the yen really shining through in terms of safe haven demand. We're seeing that dollar-yen move towards the 147 handle. The stocks that are getting really hard hit in Japan today include the lenders, perhaps overly optimistic now that we're going to see hikes from the BOJ. There was some chatter that we would see it first half of the year. Now September is not even a certainty. A gauge of them is declining by the most since the yen carry trade unwind of last August. Flip the board just very quickly. Take a look at Chinese stocks. Yes, it is bad in the markets, but maybe not as bad, actually managing to pare some of those declines despite these tariffs on China higher than expected. The idea that now authorities could front load fiscal stimulus to deal with the U.S. levies.
That banking performance really surprising there. Avril Hong in Singapore walking us through some of these Asian markets. And also, just as a reminder, yesterday we did get the reciprocal tariffs announcements, but also remember the automobile tariff imports? Well, those are actually going into effect as of a couple of minutes ago. So those 25% tariffs on U.S. automobile imports have now gone into effect as of 5 minutes ago. So those have now actually been triggered. The latest ones from yesterday will not go into effect until the broad ones, April the 5th, and then the reciprocal ones on April the 9th. It's very difficult to keep track of all of these announcements, but global financial markets have been hit by a sweeping sell-off after President Trump's bid to remake the world trading order proved more aggressive than expected. As we've been talking about, stocks have plunged, treasuries have rallied, the yen has gained, and all of this has alarmed investors searching for havens. Commodities sensitive to growth also fell, including oil.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number barring retaliation.
We have always been ready to negotiate with the United States to remove the remaining barriers to transatlantic trade. At the same time, we are prepared to respond. We are already finalizing the first package of countermeasures in response to tariffs on steel. And we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
Well, for more, we're joined now by Bloomberg News Desk editor Jill Deesis. Jill, you've been busy tracking all of these announcements and the reaction across various markets. Maybe let's just start with the historical context. Just put into context for us how impactful the new rates, the tariff rates, and not just the broad rates, but the reciprocal tariff rates are vis-a-vis where we've been historically.
Yeah, I mean, look, Jumana, it's easy to look at this and just kind of look at the staggering scope of these tariff announcements that we're really weighing in here. We're looking at the steepest tariffs in a century, 90 years or so, hitting pretty much all of the U.S.'s trading partners here. I mean, you just heard there from Ursula von der Leyen of the EU how they're looking at responding. What really struck me here, this graphic on screen that you're seeing here, it's not just the EU, but a lot of nations. A lot of economies across Asia that have really, really been hit hard here. You're looking at that China number, for example, as much as 54%. If you weigh that with a bunch of additional duties that China has faced over the last several years, as the U.S.'s trade war with Beijing has really kind of waged on, you're looking at duties of as much as 70% or so, according to some economic calculations on some goods. Obviously, many other nations sort of across the region, Japan, Vietnam being hit with pretty steep tariffs as well. I mean, we're looking at a pretty dramatic reshaping here of the global order. Obviously, there's still some time before these tariffs go into effect. As you mentioned, it's really April the 5th, so that's Saturday when, we're looking at that the baseline 10% duty going into effect, and then April 9th for some of these higher duties to go into effect gives, nations a little bit of time to maybe try to negotiate or figure out how they're going to respond to these. But really, I mean, it's pretty staggering here.
Yeah, and it's interesting. Our colleague Anne-Marie Horder managed to speak to the Treasury Secretary Scott Bessent yesterday, and he was saying he warned countries not to reciprocate, because if they do reciprocate, then we could be looking at even higher tariff rates. This morning, I'm just noting that our Bloomberg economics team are saying in the case of China, it's actually very close to their worst case scenario. They are anticipating that these tariffs could cut China's direct exports to the U.S. by up to 80% and impact GDP by around 2.3%. How are we expecting Chinese authorities to therefore respond?
Well, yes, that's right, Shivana. Though, I think if you look at equities in China right now, you'll kind of notice that they've actually been paring some losses. I think that's mostly due to investors kind of expecting that China might have, something of a fairly strong response here. I mean, we'll have to see what that ultimately looks like, but there is some expectation that China might roll out additional stimulus sort of domestically to sort of weather the impact from these tariffs. We have heard from China's Ministry of Foreign Affairs already. They kind of just reiterated some of their, standard, sort of response looking at, how tariffs are unfair and some such. I think it's probably more likely that we'll get a more definitive response from China once we actually get closer to the time of these tariffs actually taking effect. So that's on the 5th, on the 9th. That's kind of in line with what they did last time around when, U.S. tariffs took effect. They waited until the moment that they actually took effect to respond with measures against some U.S. agricultural products, probes into, U.S. technological companies, that kind of thing. Maybe that's what we're gearing up for again. But again, we'll kind of have to see, what China actually does when these do, at the moment these go into effect.
Yeah, and also keeping a close eye on the fixing this morning. It's interesting to note that the PBOC set the fixing, the yuan fixing, lower than market estimates. So we'll see whether the currency itself is going to become a little bit of a release valve there. Bloomberg's Jill Desus, thank you so much for the reporting. Now, despite energy being spared in President Trump's tariff plan on major trading partners, oil is trading lower on fears the levies could impact crude demand in a widening trade war. For more, let's bring in Stuart Livingstone-Wallace, our executive editor for Middle East, North Africa and Russia. Okay, first of all, before we talk about the impact of these tariffs on the region, because the GCC region hasn't been spared, maybe let's just talk about the price action in oil today. Why do we think oil is down almost 3% in trading, or 2% now?
So it's about the biggest drop in a month, but it is only marginally one standard deviation away from the norm. So that's the context. But I think what you want to be looking at is the forward curve, because that's been backwardated now for months and months and months. That reflects concern about near-term supply. Mm-hmm. If you start to see that change, if you start to see it move into contango, then I think that's where the big readout is going to be. 2 or 3 big factors take into account. Number 1, maximum pressure on Iran. Number 2, OPEC is coming back with more supply. It's a small amount, it's 138,000 barrels, but remember, they were pushing, and they're finally doing it. Great timing, as always. And then number 3, can China stimulate enough to keep that demand up? So really look at that forward curve, I think, as an indicator of where we're going forward.
Can I just ask you about OPEC? Because let's just remind viewers that they've been talking about putting all these barrels back to market. Yeah. They finally announced it. This month, they are slated to bring back something like 130,000 barrels per day. Oil is sitting at $70 now. Is there any oil price level where they will say, actually, we think we're going to hold back and not bring these extra barrels back to market?
Yeah, so I mean, it depends what you mean by they. So let's start with all the countries that have been cheating on their quotas for months and months and months. Right. And then right at the other end of the scale, you've got Saudi Arabia that's basically been carrying the weight for most of the rest of them. And I think is probably somewhat fed up with it. There's a call later today, apparently, where they're going to reiterate if everyone could stick to their quotas, that would be jolly useful. So what exactly is the price at which Saudi Arabia gets worried? I mean, remember, the pressure there for Saudi Arabia is not so much its margins. It's producing at $8 a barrel or thereabouts. It's this massive spending program. Yeah, and the break-even for them is somewhere between $90 and $110 dollars a barrel or thereabouts. That's our BE estimate on that, anyway.
Yeah. So bigger deficits potentially, and then also let's also remind viewers that Aramco dividend, which is also important for the Saudi budget revenue, is going to be smaller. Let's just talk about the potential economic impact to the region on back of the tariffs. Again, a bit of a shock, because if you look at the tariff rate that are applied by countries like the UAE and Saudi on U.S. goods, it's very small. In some cases, there are no tariff rates. So this is probably coming as a bit of a shock that now their goods are going to be applied at a tariff rate of around 10%. What sort of economic impact is that going to have on the region?
I mean, I think in terms of direct trade, it's going to be pretty minimal. So they buy a lot of weapons from the U.S., that's for sure, a lot of services as well. I doubt you see too much impact there. Really, the impact, again, is the global one. They are highly dependent on the global economy chugging forward. That is looking increasingly at risk, I would say. I mean, I think you mentioned earlier 50% chance of recession. That feels about the right ballpark. So that's what's going to impact them. They have to maintain those dollar pegs. Again, that's not an easy thing to do in this environment where FX is moving around all over the place. So that's the thing to focus on. In terms of direct sales by the GCC to the US, it's pretty minimal. They haven't been big oil suppliers to the US for a very long time.
Yeah, and the U.S. actually enjoys a trade surplus with the UAE, for example, of around $24 billion. So it's not a huge number, but the knock-on effects will be indirect. Yeah. Stuart, thank you very much. Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. All right, coming up, hear why Standard Chartered Wealth Management prefers stocks over bonds and cash as Trump enacts his reciprocal tariffs. More on their market strategy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, U.S. futures are sharply lower on the tariffs announcement. Let's look at the market impact now with Manpreet Gill, AMEE CIO at Standard Chartered Wealth Management. So these are equity futures, S&P futures leaning 2.7% weaker, NASDAQ 3.2% weaker. A lot of red on the screen for European markets, for Asian markets today. Has Trump's tariff announcement wiped out all market optimism?
Well, if you read the headlines this morning, the answer would be yes. That's what it would seem to suggest. But I think a lot of the pessimism or fear was starting to get baked into markets ahead of the announcement. So I don't think the dust is completely settled. But I think, we aren't at a point where, this is catching markets completely by surprise.
Yeah, so let's talk about the U.S. economy. I've already started seeing notes this morning saying that they think, analysts think that these tariff measures are going to prove to be inflationary, adding 1 percentage point to inflation, but at the same time, a growth shock, growth negative, recession probability odds have started to climb higher again. Do you think that the U.S. is on the precipice of entering into a recession this year on back of these announcements?
Perhaps I wouldn't call it the precipice, but it is the number one risk I think we knew that was posed by tariffs going into this. Because I think to markets, we know tariffs, of course, are negative for growth, positive for inflation. I think the magnitude, of course, is where a lot of the focus is on today. The reason I say it's not a complete sort of done deal on the recession side is that we need to obviously gauge just how much, we sort of roll back in terms of negotiation. I mean, Scott Bessent has clearly held the door out in terms of a bilateral negotiation. And second is we roll back to the start of the Trump administration. It was always a toss-up between how the negative impact of tariffs offset with the positive impact of other policies, tax cuts, deregulation. So I think it's about balancing the two.
Do you see this as short-term pain, long-term gain for the U.S.? I mean, ultimately, do you think the U.S., Trump may actually succeed at delivering on what he wants to achieve, i.e. a rewiring of the global trading system, making trade more fair for the U.S., bringing manufacturing jobs back to the U.S., and he talks about all of these things. Do you think there's a chance he actually is successful in the medium term?
Well, it's clearly a gamble. I mean, we've all read the research in terms of how this policy, is meant to pan out. And look, you can't sort of rule the fact that these things could work out. But for financial market investors, though, I think the pathway to any such final outcome is equally important. And I think that's where a lot of the debate today about the recession risk versus the offsetting factors. I think for us to help answer that question and understand what pathway we're going down, the success or not long term, I think the clue will sit in indicators like the US dollar. Because I think that would be perhaps one of the first areas we'd start to see whether we break out of the range, truly get a weaker dollar or not.
Yeah, but the theme seems to be one of dollar weakness. So let me ask you, are you changing any of your investment thesis based on what you found out in the last 24 hours? Have you changed your allocation? Are you looking to change your asset allocation because of the news?
Look, at the moment, we have not. And look, it's prudent to relook at it. We do that every single month, so I don't see any changes from that perspective. But I think what's interesting is where we start the conversation. The headlines, of course, coming as quite a potential negative. But then if I look at the dollar, it's still in the range. I look at VIX, it's very much like, the two sort of short-lived corrections we had over the past year. So that's why, we wouldn't look at this universally negative. We would wait for the dust to settle. Clearly, markets where there's equities or bonds clearly moving towards supports, which are still a few percentage points away, but we would take a more balanced approach. We think diversification, but also being open to the idea that perhaps there are a few opportunities to buy if markets continue to move to those supports.
So where are you allocating right now?
So I think, number one, we'd still keep a moderate overweight to equities within the context of a diversified portfolio. I think the diversification is important because we've just seen the value of bonds, of gold, of the Japanese yen as diversifiers. So it's not a singular call. Second is across regions. I think in the US, we've always been fans of the little pocket in technology software. I think adding more to Europe, we're much more neutral across regions. That's one shift we made in the last couple of weeks. So especially if we get a pullback in European equities, we'll look a bit stretched. We'll be looking to even out our positioning between the US and Europe compared to the overweight we had in the US. And I think in China, we have been of the view that we're due a healthy correction. We've seen quite a strong rally, but if we saw the Hang Seng pull back to about 21,600 or so, that's another area we'd be willing to potentially dip our toes in a little bit more.
Yeah, and even the price action today suggests a moderate response out of some of these Hong Kong and Chinese indices. It tells you that maybe a lot of the pessimism was actually priced in already.
That's what we're really trying to gauge.
Manpreet, thank you so much. Great to have you with us on such a big day. Manpreet Gill, a Chief Investment Officer at Standard Chartered Wealth Management. And still ahead on Bloomberg, we'll be speaking live with U.S. Commerce Secretary Howard Lutnick following President Trump's Liberation Day tariff rollout. That's coming up on Bloomberg Surveillance at the times on your screen much later in the day. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. Israel has launched multiple airstrikes across Syria, hitting the capital Damascus, as well as the cities of Hama and Homs. Syria's foreign ministry says the bombardment lasted 30 minutes and injured civilians and military personnel. Israel has attacked military infrastructure and seized weapons in Syria since the fall of President Bashar al-Assad as part of a new defense doctrine intended to prevent a surprise attack. And Tesla sales fell 13% last quarter to an almost 3-year low as the car maker revamped its Model Y EV and dealt with an international backlash against the CEO Elon Musk. The electric car pioneer delivered just under 337,000 vehicles, its worst showing since the second quarter of 2022. Musk's involvement in government cutbacks and support of far-right candidates and causes has sparked protests across the U.S. and Europe. Shares are down more than 40% from a high after President Trump's election win. And today we are tracking the price action across global markets after Trump's tariff announcements yesterday. S&P futures down 2.7%, Nasdaq down 3%. A heavy session inside for European markets as well, leaning towards the red, down 1.7%. And then the handover from Asia, not so pretty this morning either, with the Nikkei down 3.2%. More on that in just a moment. We'll be right back analyzing the impact and the potential reaction out of some of these major nations to that big tariff announcement yesterday. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Global sell-off. President Trump's announcement of a minimum 10% tariff on all exporters to the U.S. spooks investors. Havens rally on fears of an escalating trade war. Do not retaliate. U.S. Treasury Secretary Scott Bessent warns trading partners it could get worse if they fight back. And oil declines on fears a trade war could threaten global demand despite energy being spared in the tariff rollout. Well, it has just gone 8:30 a.m. across the Emirates. I'm Joanna Versace in Dubai. A tariff earthquake is what I would call it. And the announcement that we got yesterday, many people saying that the overall announcements, both on broad tariffs to imported goods into the U.S. and on those reciprocal tariffs targeting 50 nations, are close to the worst case scenario. And it's very clear that the Trump administration is pursuing a maximalist approach on these tariffs impositions. And on the back of that, markets are boiled this morning. There's a sea of red behind me for all of these global stock market indices. Futures in the U.S. leaning deeply towards the red. The S&P futures down 2.8%. Nasdaq down 3.3%. Again, tracking losses for the year. The Nasdaq close to 10% losses year to date now. And this on concerns very much around the U.S. economy. Poly markets, recession odds overnight have now shot up to more than 50%. People really are concerned about the impact that these tariffs are going to have, not just on the U.S. economy, but the global economy as well. Hence why we're seeing a reaction in European markets this morning, 1.8% weaker, as we heard from the likes of the European Commission President Ursula von der Leyen a short while ago, saying that this is not the path that they wanted, but they will likely have to come up with some sort of counter response as well. We'll speak shortly to Oliver Crook about what Europe are planning on doing. And then the handover from Asia Pacific also negative as well, down 1.4%. Close eye on some of those key indices, Chinese markets, Hong Kong Kong markets in the red, but perhaps not as deeply negative as we thought it was going to be. Vietnam, for example, posting its worst day in more than 4 years. So many of these Southeast Asian economies are feeling the heat as well. Switching over, this is what we're seeing in terms of safe haven flights today. The yen, we've seen a big shakeout in the Nikkei earlier on. Avril was just talking through the impact on the banking space with some of those stocks down more than 5 to 8%. But the yen is stronger, 1.4% firmer versus the USD. So a typical sort of risk-off trades going on there. Gold, all-time highs once more, up 0.4%. Geopolitical uncertainty, inflation scares, all of that contributing to gold that continues to go up. 10-year yields, take a look at that. 8 basis points lower today. We're getting close to 4% again. It wasn't that long ago. We were talking about 4.3, 4.4%. We've come a really long way this year in terms of how far these yields have traveled. So sitting close to 4%. And then crude, you can see now we have broken through $70 to the downside, so down 2.5% this morning. And this, again, on fundamentals and the fact that not only are OPEC Plus bringing back extra supply to the market this month, but there are now serious concerns about global demand, given the impact that these tariffs could have on the demand outlook for some of the biggest nations around the world, from the US to Europe to China. Okay, let's zoom in a little bit on how Asian currencies are faring. Avril, in the first part of the show, we were talking about the equity market reaction, but I think Asian currency reaction is interesting as well, because for the most part, we have seen dollar trading weaker this morning. How is that having an impact on some of these key Asian currencies we're tracking as well?
Yeah, it's really interesting, right? Because if you zoom out into the region, most of the currencies are declining despite some slight dollar weakness. And I think this page is a good one to show you because it shows you the market dislocation and how traders are treating the EMs versus the DMs. Vietnam, for example, 46% tariffs, and the currency, the Vietnam dong, plunging to the lowest on record. We're also seeing the Japanese yen, as you highlighted, receiving that safe haven demand. And keep in mind that as dollar yen moves towards 147, it's also not far from the lows of the year, 146.5, thereabouts. Even the Singapore dollar, despite Singapore getting 10% tariffs, is firming up a little. So maybe in the region, Southeast Asia, it's also seen as a bit of a safe haven. Now, the Chinese renminbi is also really interesting to watch. I mean, we saw the onshore hitting lowest in about 7 weeks, but offshore, we're seeing it relatively stable. And for this, I think it's key to watch the signals from the PBOC because we got the weakest fix since January, but it was still stronger than traders' estimates. So what this tells us is that even for the likes of the PBOC, what they don't want to see is rapid depreciation of the Chinese currency, even with these tariff headwinds. So that's what you're seeing across FX today.
Yeah, keeping a close eye on the yuan there. Avril Hong in Singapore, thank you so much. Let's go back to the top story. President Trump has imposed the steepest American tariffs in a century on all U.S. imports. His campaign to reshape the global economy will see higher duties on some of its biggest trading partners, such as China, the EU, Japan, and Vietnam. Now, let's take a deep dive into the reaction from across Europe and Asia with Bloomberg's Oliver Crook in Brussels and China correspondent Min Lo from Hong Kong, our roundtable this morning. Good morning to you both. Min, let me just start with you. Our Bloomberg economics team were saying that this imposition, these set of tariffs, are close to the worst case scenario that they had actually envisioned for China, taking the total tariff rate to above 50%. What has been the reaction from Chinese authorities so far?
Yeah, it's really worse than the worst case scenario that many people had been planning for, because you look at the 34%, the reciprocal tariffs there, you add to that the 20% that were pre-existing, plus you add the legacy tariffs that were in place before Trump came into power. Bloomberg Economics saying that it's about 67% tariffs on Chinese goods so far, more than even what Trump had telegraphed on the campaign trail. And Bloomberg Economics say this could shave off about 2.3% of China's GDP, which is pretty significant significant, and it could cut China's exports to the United States by 80%. That's just talking about direct exports. If you look at indirect exports, the sort of goods that were transported to the U.S. via third-party countries like Vietnam, that could be even bigger of an impact. In terms of China's response so far, we heard from the Commerce Ministry this morning saying they are strongly opposed to the tariffs. They're asking the U.S. to scrap all these unilateral tariffs, saying that China is vowing to take countermeasures. They have not detailed what those measures will be or when they will be in place, but judging from previous rounds of tariffs that had been imposed from the U.S., China typically takes those countermeasures on the day they take effect. So we're looking at April 5th or potentially April 9th for any countermeasures from China. We are also hearing from sources unofficially that the NDRC, the top economic planner, had been told to put on hold any approvals for Chinese companies looking to invest in the U.S. So holding back that foreign direct investment into the U.S. for now while they assess the impact. And as Avril said, the first big move we had seen is from the PBOC's fix, which was about 0.13% higher than yesterday, showing that China is willing to use that currency as a potential way to soften the impact of tariffs.
Yeah, interesting point there on the fix. Let's turn to Oliver Crook and the reaction from European nations at 20% reciprocal tariff rate. Oliver, I guess the question is, do they fight back or do they try to negotiate a deal here?
Well, the answer for the time being is they will not fight back. They will basically take these tariffs. They're going to basically sort of take a little bit of time to assess what their sort of impact is going to be and also try to assess how basically the Trump administration has calculated this rate of 39%, right? That is how much they say that the EU is the terms of trade barriers that exist between the European Union and the United States, which is why they've given them a 20% tariff, which is, by the way, pretty close to the worst case scenario for the EU. The officials here were expecting something between 10 and 25%. They got 20%. That is obviously a very sort of sizable tariff for the EU. We're talking about $1 trillion worth of trade on an annual basis. The sort of trade deficit to the EU's favor is about $200 billion, and that is really what the Trump administration has taken into its sights to try to resolve. What is interesting is that they are trying to address that trade imbalance, not just because of the tariff rate for the EU. And this is where things are going to get very interesting for EU policymakers, because Trump last night kept talking about non-monetary barriers, non-tariff barriers, and that is what he wants to address. So he was talking explicitly in the EU, saying that there's an effective ban, for example, because of regulations in the European Union on basically the import of American poultry. So for European policymakers, so their main response right now is not going to be immediately to impose tariffs. It is to be basically try to appraise how the Trump administration is calculating the trade barriers and try to find ways in order to address that issue, an issue that they acknowledge to a certain degree that you cannot deny that there is a trade imbalance between the EU and the United States, particularly on the question of goods. Services, actually, the U.S. runs a surplus. This is a point, by the way, that European policymakers have tried to make to the Trump administration, but to no avail.
Yeah, and also looking ahead, Oliver, maybe just walk us through the timeline over the next couple of days, because also in parallel, there is a NATO foreign ministers meeting taking place. And you've got to think the politics of all of this is going to be intersecting at that meeting as well, as you talk about Europe having to be more self-reliant when it comes to things like defense. So it's not just the economy and tariffs we're talking about, but also defense and shoring up a unified position on Ukraine.
Yeah, Jumana, I think that's what makes this so sort of interesting. We have within hours of these sort of tariffs coming into effect, the 25% on auto tariffs, and of course the announcement last night, you have Marco Rubio, the Secretary of State of the United States, landing here in Brussels in the next couple of hours to have a foreign ministers meeting with NATO, right? And as this Trump administration tries to right a lot of the sort of perceived wrongs that they have across the board, whether it's about taking care of European defense, whether it's about trade imbalance, all of these issues will inevitably bleed into one another. Sometimes more explicitly, sometimes less explicitly. But at the end of the day, the Europeans need the Trump administration on side, A, for European defense, but B, to find a sort of decent resolution to all of the issues that there are in Ukraine and try to end the war. They need the Trump administration on side, so they don't particularly want to antagonize them. In addition to the fact that the NATO alliance itself is probably in its most sort of tenuous position, certainly in recent history, maybe in its entire history, at a time now when Marco Rubio arrives in Europe in order to have some of these these discussions with foreign ministers. I'd be very interested to know how much of the conversation is going to be about defense in Ukraine, how much of it is going to be about tariffs. We're going to speak to a number of foreign ministers throughout the day, today and tomorrow, and we'll be putting that question to them.
Yeah. Oliver, great to have you on. Bloomberg's Oliver Crook giving us the European perspective, and Min Min Lo running us through what the response has been from China so far. Thank you very much. Now, President Trump's tariff announcement saw the dollar fall against G10 currencies, while the yen rallied. Joining us now is Mahjabeen Zaman, head of FX research at ANZ. Good to have you with us. Let's just start with the reaction in the USD today, because despite all of these tariff announcements, the dollar is actually trading weaker. Is this the right response, do you think? Are currency investors on the right side of the trade?
Look, you would imagine that tariff news definitely would lead to a rise in the dollar rather than a fall. But look, I think the market really suggests that, maybe the initial move is really looking beyond how tariffs impact business and consumer confidence, and ultimately looking at the hard data of consumption in business investment, which will likely be a Q2 story. Look, I think in the near term, we still have the view that we will see a stronger dollar, a little bit of this weaker dollar, stronger euro story that we're seeing just a few hours into this announcement could be the view that maybe there might be some room for negotiation. At the end of the day, the multi-level tariffs are really only going to go live on the 9th of April. So that gives us a couple of days to see any sort of reconciliation that could take place. And maybe that's what the market is pricing in at this stage.
What if the U.S. does actually enter into a recession? What happens to the USD under that scenario?
Yeah, look, I think for the dollar, it's quite interesting. If the U.S., that's not our base case, but if there is a recessionary environment for the U.S., it also matters what the rest of the world is doing, right? If the rest of the world is also in the slower global growth environment, likely we see the dollar tend to benefit in this environment. But I think what we are kind of seeing at this stage is that, yes, there will be some moderation in growth in the U.S. from pretty high levels that we have seen over the last many years. So fading U.S. exceptionalism. But when we look at relative growth differentials, still sort of feels like there's a little bit of a bias to the stronger U.S. economic momentum relative to the rest of the world. You know what I mean?
How much is the yuan fixing from here on going to affect where the dollar ends up trading over the short term? And we're keeping a close eye on where the PBOC are allowing the currency to fix. It did come in a little bit higher, but perhaps not as weak as people had anticipated this morning. But if the Chinese authorities do allow for a continual weakness in the yuan, what sort of knock-on effects will that have to the USD and currencies around the world?
Look, I think the move in the CNY, if it continues to weaken from here, surely it will have a spillover effect, especially on Asian FX, as well as Aussie and Kiwi dollar, which tend to be proxies for the CNY. We do expect the CNY to be moving towards that 750 mark over the course of the year, but it will not be a sharp adjustment. We saw a gradual fixed adjustment today and probably see a more gradual move as we go along to avoid any volatility. Broad Asian FX has already moved a little bit ahead of this announcement. We have seen weaker Southeast Asian currencies, and the Aussie and the Kiwi. We could argue over the course of the last couple of months we have had a weaker dollar, but the Aussie and Kiwi have not rallied, and it's for really this reason, in anticipation of what happens with the Chinese yuan, because that correlation remains pretty strong.
Yeah. I mean, the typical FX adjustment mechanism is that the countries that have had tariff rates applied to, should have their currencies weakened to sort of adjust for that dynamic to make them relatively more attractive. And yet what we're seeing this morning, the euro is firmer, the pound is trading firmer, the Japanese yen is trading firmer. It just all seems a little bit counterintuitive. What do you think investors or the market is missing here?
Look, I think there are first-order effects and there's second-order effects. Now, I think the starting point of every economy today, as tariffs come on board, is very different to where it was in Trump 1.0. We are at a point where we are already starting to see a little bit of a slower economic momentum in the U.S. off the back of many years of exceptionalism. I think that's impacting what the U.S. dollar is reflecting. And further to that, of course, we are in a week where we're going to get jobs data that will be key driver into what the market expects in terms of the growth dynamics of the U.S. But at the front end of everything, given there's so much switch on, switch off of tariffs that we've seen with Canada and Mexico, there is a lot of uncertainty around the U.S. businesses side of things in terms of how they should invest, where should they be spending their money, whether they should be hiring or holding on to all of those, investment spends. And I think that's really what's really reflecting in the U.S. Economic data. And sentiment is the first and foremost driver of all of that, and that's really weak at this stage.
Yeah, that's such a good point on sentiment and whether or not people are going to feel better or worse after this these series of announcements remains to be seen. Mahjabeen Zaman, head of FX research at ANZ, thank you so much. Now, coming up, we're going to switch tacks a little bit away from tariffs. Cracks appear in South Africa's coalition after Parliament backs a budget law despite opposition from within the government. We're live in Cape Town next with the latest. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. South Africa's parliament has approved a key piece of budget legislation despite objections from the second biggest party in the coalition government, raising the risk of the alliance unraveling.
I don't think you can vote against a budget and tomorrow you want to go and be part of its implementation. It can't be.
Well, that was the country's finance minister there warning the Democratic Alliance of the consequences of voting against the budget. For more, let's bring in Bloomberg's Paul Vecchiato in Cape Town. Paul, so this story, I mean, this has been going on for a couple of weeks now, the challenge of getting a budget passed through Parliament. And there still seems to be a lot of daylight between the two major ruling parties. Is the coalition at risk?
It certainly seems to be. One senior Democratic Alliance leader yesterday said to me, they think they will exit the GNU, but the last part of the play is still to be played out. In other words, still something. I'm not sure exactly what they're looking at. The Democratic Alliance have also launched a court challenge, where they're filing the papers this morning, against the process that led to the adoption of this report. They think it was very flawed in terms of law and in terms of parliamentary processes.
Yeah. How did we get here in the first place? I mean, was the catalyst that initial budget with the surprise potential VAT hike, or were there fractures beginning to emerge anyway before the whole budget discussion took place?
Yeah, there was tension beginning to emerge. The DA complained that the African National Congress, which is a large chunk of seats, were acting as if they were solely in power when they should be part of a government of national unity. And we're just trying to quote the DA saying, ram their policies down their throats and just expect them to approve them. So we saw that with things such as the Expropriation Act, the National Health Insurance Act, those kind of things where the DA's not entirely opposed to those laws, but certain elements of those laws. Now, with the budget and the VAT hike, which was initially a proposal of an immediate increase of 2 percentage points, the DA were really unhappy about that, forcing a rewrite of the budget, which was tabled and brought in a 0.5% increase, and the DA is still are really unhappy about that still.
Yeah. Well, let's see what happens there. The rand weakening against the USD this morning, but that may be also in response to the tariff announcements as well, with South Africa not spared too. So that's going to have an impact on GDP. Bloomberg's Paul Vecchiato, thank you so much for the report. Speaking of tariffs, let's get a quick check of the markets before we go to break. S&P futures leaning towards the red, and NASDAQ as well. Both of these indices pointing to a very negative session at the open. NASDAQ down 3.2% now. Those futures, Asia Pacific, the Hanover also red as well. Back in a moment. This is Bloomberg.
It's the perfect entree to let's make a deal.
He's ran on this for the last 4 years, really, is that he needs to make sure that the other countries are paying what they deserve.
There was nothing truly consistent about this rollout each country truly is affected differently and to a higher degree than what I think many were factoring in.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number.
I think it's going to be a very, very bumpy road, and we may well look back on this as sort of a knife edge of the economic prosperity of the United States for some time to come.
Some of our guests sharing their insights on President Trump's global tariffs. This is the picture for equity markets, all pointing towards a very negative open in a couple of hours' time, but also safe haven seeing a bid today. Money pouring into the Japanese yen. We're about 1.3% firmer versus the USD. Gold at an all-time record high, as well as the safe haven continues to benefit from those flows as well. And then oil, keeping a close eye on the impact global demand is having on the commodity. But that is it for our Horizons show. Daybreak Europe is coming up next.